Welcome to yet another beautiful episode of The Green Line right here on Rapid TV. It's been an amazing week so far, and I hear the preparations are still on and are going pretty tough in the marketplace. Last week, we were able to access some of the prices of things in the marketplace, from birds, that includes turkey, chicken, guinea fowl, and everything that you guys eat. And surprisingly, when I got there, they said, there's rabbit here also. And I'm like, you people eat rabbits? Do people actually eat rabbits? But anyway, they sell it over there and a whole lot of other things. Now, one thing that was very constant about the interviews that we did in the market was the fact that the prices of things have significantly reduced. But regardless of that fact, people are still not able to afford the basic things: rice, oil, the grains, the spices, and all of that. Why exactly is that still the case? Of course, we'll go back into the marketplace to see how that was talked about. How are you doing today?
I'm fine.
Okay, so what have you been buying in the market throughout?
I've been buying food stuff like beans, rice, and other things, other food stuff, food items.
Okay, so what is your general observation about the market?
The price, the thing is coming down. The price is cheap, but there is no money to buy. Okay. So things are cheap, but how can you buy if you don't have money?
Okay, how cheap are they?
It has reduced though. Like for beans now, beans really came down. The price came down, unlike before.
I'm selling fruit, watermelon, pineapple, avocado, and tangerine fruit. All we are selling here, and grapes also.
Okay. So how is market like?
Market is going well, sha, but we are just managing because now people are traveling. Christmas almost reached. People they travel now, so we do manage and small.
Christmas has come. What do you sell in your shop?
As you can see, we are selling varieties of things in our shop, like spaghetti, indomie, semo, oil, rice, and so on and so forth.
Okay, so now what is patronage like? Are people coming to buy compared to other Christmas seasons that you've been here?
Actually, this year is a little bit different because like other year, by this time we see a lot of people trooping into the market, buy varieties, despite the fact that the price are a little bit down this year, yet there's no much sales like other years.
Okay, so you agree that the prices of things have significantly reduced in the market?
Some of the items.
Okay. Like what items?
Like anything food stuff. I think we can boldly say that there is a reduction in it.
We know that the prices of things generally, from the body language of the traders, have significantly reduced. But for birds, we'll find out right now.
Kobo by name, the chairman of chicken section here.
Okay, all right. And since you are the chairman, that means we're at the right place.
You're in the right spot, really.
Okay, so tell us, what is the bird market like here?
You can see by yourself the market was calm. It's quite calm. It's not booming. No customer. You can see by yourself. People are just coming once. After one customer come, before you can see another customer, it will take you like 15 to 20 minutes. On a good day, when they say Xmas is around the corner, people try to buy things and stock it. As time goes on, I don't know how it will be, but for now, honestly, the market was very poor.
Welcome back, and thanks for staying with us. As always, we'd have someone here to have the conversation with us every other week. But now the focus of today says that across Nigeria, farmers are producing food under some of the toughest conditions imaginable, or sometimes unimaginable. Rising input costs, climate pressure, poor storage, and shrinking profit margins. Yet one challenge sits at the center of it all, which is access to finance. Now, for millions of farmers, credit is either unavailable, unaffordable, or poorly structured for agricultural realities. And this results in low productivity, high post-harvest losses, the farmers trapped in circles of subsistence rather than profit. And on today's edition of The Green Line, we take a hard look at why finance remains out of reach for many farmers, what is broken in the current system, and most importantly, what can realistically work from government interventions to private capital and agri-fintech solutions. This conversation is about basically unlocking finance that actually help farmers grow, earn, and to sustain their livelihoods. Because if the farmers are okay, then the market will definitely smile. And to have that conversation with us today is our 2-3-time guest here on the Green Line, Mr. Damion Udoh. Good morning to you.
Good morning. Thank you very much for having me again.
Yes.
Always a delight to be here.
Always, always. He's the CEO of Quick Leaps, team lead, and you see he's representing both his organization, representing both Green Line, representing everything. Banker, touch a lot of money. Yeah. are you the one actually giving the farmers? Because you look like you are dispensing these funds to farmers.
Well, we're working on something that's going to actively dispense funds to farmers, food system actors, not just in Nigeria but around the globe. It's called the Food Finance Fund, and it's a decentralized finance play. Its goal is to galvanize global capital from around the world and make that accessible and affordable to food system actors. So while also building on, think about it as a financial layer under the agricultural sector, right? Essentially what we are trying to do is, as more than just access capital, right, or galvanize capital to make it affordable and accessible to food system actors. We also want to build on systems around tokenization for the output of those agricultural, like all of those production, right? So we want you to be able to trade safe assets like wheat, corn, all tokenized and made available on the blockchain.
Interesting. Now, when we talk about access to finance for farmers, why is it such an important conversation? Although, I mean, finance, everyone knows it's about money. So if you give someone a business who is at 10%, someone running a business that is currently at 10%, agric or not, and you help them with an amount of money, it can almost automatically move them from 10% to 20, 30, 40, or 50, as the case may be. So why is it so important for farmers, and why is this such a conversation that should be in the agri space?
So wonderful, thank you. So whether you're an institutional investor in the food space or you are, say, a smallholder farmer, if you had to take Nigeria as a country, for example, we have stats that says we have about 38 million smallholder farmers. All of those 38 million smallholder farmers need access to financing. The way they create food or the way they produce food is that they have finances to buy inputs, right? If they don't have lands, they have to rent lands. When they have the lands already, they need the inputs, everything from seeds to the kinds of fertilizers that they use to grow food, right? So like I said, whether you're a smallholder farmer or you're an institutional investor, finance is an important ingredient. It's at the crust of your production, your storage, and all the other activities that you carry out in capturing food or in producing food. So I mean, it's at the bedrock, right? If there were ways to get seeds without finances, I think farmers would get them, right? But right now you need finances to get
literally everything.
to get literally almost every part of the food production value chain requires some form of resource. So let's call finance that broad scale in terms of like resources. You need resources to get things done.
All right. Now data shows that about 80% of farmers here in Nigeria are smallholder farmers, and some have argued that the reason we still have a lot of people operating in the smaller level is because they don't have access to finance. But regardless of that fact, 7 to 8% of them still find it difficult to access credit. Why is there so much gap between the number of people that are smallholder farmers, the people who have access to credit, and the people who are just doing subsistence level of farming? Why is this such a wide gap?
I think it's maybe even larger than 78%. Interestingly, when you think about it, right? We had, I mean, we have World Food Day Forum. It's an event quickly created, and when you think about World Food Day, when you think about the conversation we had on World Food Day Forum was around financing agri-food systems, financing good food outcomes. And when you think about that generally, there were a couple of things that we found out, right? One, data. So money will follow clarity. You have to present very, very clear investable options for fund managers or allocators of capital around the world to be able to dispense that capital to. Because, I mean, anybody allocating capital needs to have clarity around the ecosystem to see, it's like this particular value chain, this is how much is needed, this is where the money goes to, these are the risks at these different points. It's almost like a value map for all of the different touch points that the money is going to kind of like be creating value at, and all of that value is going to be captured back, right? So I think number one is clarity around data. When it comes to the number of smallholder farmers, there's clarity around data around that. That's a large investable opportunity, because all of those people put to work with finances would have output. All of that output sold to markets is return on investment, right? Same thing for institutional investors. So we have issues around clarity around data. We have issues with just affordability of the financing, right? So if you're going to fight like current interest rates in Nigeria as a country, if you are going to go and present that to a farmer and say take 20% money, and it's really, really expensive. So finances, or the kind of financing we need in the agri-food space, needs to be very tailored, right? So I call it native intelligence. It's like financing native to specific value chains, not just to the food space, but then breaking it down to value chains and then creating products, financial products that are very, very native to those different value chains. Financing generally needs to be affordable, and it needs to be accessible. So some of this financing is available, but the information about it doesn't get down to the people who need it. It's also good to always start with what works, and so we have food players in the space who are doing really remarkable work with outgrower programs, dispensing millions and millions of dollars to smallholder farmers. That's still only a fraction of the need, and there's still a massive gap. And this is only Nigeria. When we think about a food secure world, you think about the rest of Africa, you think about the rest of the world. We need to pull together financing, and those finances need to be affordable, and they need to be accessible to the people who need them.
Okay. Now, many farmers complain that even after a good harvest, they still have very low profits. And it's very concerning, because if you have a good harvest, it should automatically translate to good profits, especially if the crops are healthy, or the food crops are healthy and they're in large quantities. But still, they find it difficult to have like increased profit. How much of this you think is linked to lack of financing?
Okay, since you've tailored it to lack of financing, so yes, I mean, cost of money. Right,
cost of money.
He's
giving how much is money.
Right, exactly. Because I mean, very, very literally, when you think about it, how much is the money that is financing your operations coming to you at? So if for example, let's say you had the best practices as far as agronomy goes, and you had wonderful yields, right? If the primary costs of the capital, the constituent cost of production, everything that went into your production process was very, very high, because you're paying back that money, and you're paying back that money at a determined rate with a determined interest. It doesn't matter how great your yield was. If the cost was very, very high, you would find that you're working with very thin margins. Now, if you have like super great off-takers, and then the prices worked very, very well, then you could still have a great profit. But the cost of money really, really, really matters. And it matters more than just the profit the farmers make, because the farmers are on one end. Our food systems are not complete without me and you, who are consuming the food from all of that production, food capture and food production process. Now, if the cost of money is high, then the cost of food in the market is high for me and you. The cost of food outputs for industries is also high, and that's after that's being processed, that relates to higher cost as far as like whatever it is you're buying that's being processed out. I mean, so making affordable financing available for some actors is a non-negotiable at this point. It affects every other area of life as a whole.
Now that we've talked about the farmers who actually have good harvest and are looking forward to having good profits, let's also talk about the farmers that lost their crops. Statistics also say that 30 to 40% of farmers here in Nigeria experience post-harvest losses. Or am I getting that right? I mean, 30 to 40% of some crops, not even the farmers. So imagine that we have 100% of farm produce. 30 to 40% gets bad. And from a finance perspective, because some farmers have also argued that it's because we don't have enough financing to be able to create systems or strategies that can help us preserve these goods at a longer period of time. From a finance perspective, how much of a role do you think that lack of finance or poor access to finance for farmers have to play, especially when it comes to post-harvest losses?
Thank you. So we have very interesting stats. Actually, the statistics are actually higher for what post-harvest losses are. And depending on the value chain you're looking at, that's where it comes higher. In perishables, is a lot higher than 30 to 40%. I think it's you have to take a very holistic approach when you're talking about this one. Two key things come to mind. One is patient financing. You have to kind of design like I said, native financing, very native to the value chain and to the specific need. So when you think about our food systems as a whole, when you're designing them, you have food capturing, you have food production, you have storage infrastructure, you have distribution, delivery, and a number of other like different touch points you would touch when you're designing food systems, right? For very, very specifically to reduce post-harvest losses, it starts from everything from, you have to plan from when you're planting. So everything from when we planted to when we harvested, financing, I mentioned patient capital to finance the kind of infrastructure that is needed to reduce, actually eliminate those post-harvest losses.
Yeah.
So for example, if you're doing strawberries in Jos or in any other part of Africa and the world, you need cold storage, right?
Okay.
If you're doing, say, you're capturing fish whether you produce those, you grew them, or you kind of like fishing, you actually need to have the infrastructure for blasting, drying, degutting, all of those processes in place to make sure that the value that is captured is actually stored, preserved, and that in the right conditions, and that it gets to the people who need them at the right time, right?
Yeah.
The condition it gets to people actually matters a lot. You don't want to have food poisoning and any of those kind of things happen. So we need to structure financing that actually goes to the infrastructure needed to eliminate post-harvest losses. Then of course, for farmers who lost their food, once we're able to bring in, there are ways to de-risk this investment. Insurance as a key one, and then a couple of other practices. Once you insure, then you could have, payments come back for those things that were lost. Exactly. Yeah.
Okay. Now, banks often classify agriculture as a too risky investment, and so it's either the banking system does not even accommodate agriculture at all, or they are too scared to venture into it. So it's difficult for farmers there. Also, collateral is a major issue because farmers don't have like official title documents for the lands that they actually farm on, and so it's difficult. It's either the system does not have the structure, or the farmers do not have the title documents that can help them be found. I know that the federal government is doing a lot now, especially when it comes to having accurate data of these farmers and the location of their farms and what have you. But how can financing work in such an environment where the system does not even recognize, what can happen in the agricultural sector, or the farmers are not prepared to receive such a help from the government or civil society organizations? How do you think that financing can work in an environment like this? So
for that to work, we have to have comprehensive collateralization. That's simply just very, very, very comprehensive approach to saying how we collateralize and the money that comes. It might, again, remember, any allocator of capital wants to see that this is a safe and a very, very well thought out, investment before they put their money into it, right? And so in creating those comprehensive collateralization systems, you're thinking about, number one, you want to have clarity around data again. Who is the farmer? Who are the farmers? How long have they been farming? Thank God for technology around AI and geolocation. You can know where the farm is, even if you don't have the underlying, for example, documentation for those properties, that you know where the land is, and you can see it, you can geomap that, and you have data around the space. It's safe to plant in. You don't have issues, security issues and all of that kind of stuff. That's that first part. Second part is now like going more into the terms of like, if this farmer were to default, how does that money come back? These are not new systems. The systems, the organizations within Nigeria, for starters, Ghana, South Africa, that are already financing farmers and having very, 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 very low default rates on all of those assets. For example, Triva has dispensed, they've done way over $100 million in revenue. Triva Greek. You have Effects that's done, of course, tens of millions of dollars also. I don't have the exact figure for Effects. The Babongo now, of course, massive figures, right? Quickly also there, and of course now with the Food Finance Fund, many people have built out those systems already. So for collateralization, we've built out a system that's 3-layered, right? I'm happy to talk more about that. But it simply has 3 layers within, not just data and all of those other stuff, just within people. Like when you think about the people component of it, to say, layer 1, layer 2, layer 3.
Absolutely.
Fail safes to make sure that the finances will come back right to the investors who made the finances available. And then, of course, again, insurance as another added layer within that comprehensive collateralization package to ensure that these investments are safe, right? Once they are safe, you can present them to allocators of capital anywhere around the world, and they will deploy capital to them. But this capital needs to be patient, and the cost of the capital needs to you can't be giving 20% money, right? So which is why we're thinking about, which is what's available within traditional finance. So we're now exploring more decentralized financing where people from around the world could, actually finance this, food outcomes, and then
Interesting. We have been with Mr. Damion Udoh. It's always a delight having you here, by the way.
Thank you.
And we have been talking about agri-financing, what is available for these farmers, how can they get enough resources so that they can either multiply their farming or they can maintain what they already have, because as we speak, having 30 to 40% as post-harvest is quite a lot. Amount of money that could have been able to generate more money for them in the marketplace. But we'll go out on a very short break, and when we get back, we'll keep up this conversation. Please stay with us.
From the soil beneath our feet to the tables across the world, agriculture is the heartbeat of Nigeria's future. Yet challenges persist: limited finance, outdated methods, policy gaps, and untapped opportunities. The Green Line is here to change that. A groundbreaking weekly television feature that connects policy with practice, farmers with markets, and innovation with impact. We dig deep into the full agricultural value chain, from land preparation to mechanization, financing, food preservation, exports, and beyond. The Green Line isn't just a show, it's a national development platform. Join me every Friday at 11 a.m. only on Rapid TV, Star Times Channel 176, and online at www.rbnradiotv.com.
Welcome back, and thanks for staying with us. So we have been having this conversation on access to finance for farmers, creating a market for them, basically. I always will say that if the farmers are happy, the consumers will also be happy. If the systems are favorable to the farmers, it will be favorable to us, the consumers, in the marketplace. However, we encourage that you also be a farmer so that we can reduce the burden on some of these farmers, and then we can have more circulation of food in the marketplace. Thank you so much, Mr. Damion, for being here with us today. Now let's go to another very interesting conversation, or important one, by the way. I see that the interest rate is another very big concern for farmers. We're talking about the MPR rate, which is at 27% right now. How many farmers can actually afford to pay back 27% of what they receive in loans? And aside that, there are other factors that would frustrate the market, which I think that should be put into consideration. Because if I'm saying, there are hazards for every crop that you plant. I remember one time where I was trying to farm potatoes and somewhere around Jos, and then they said that the rain came and it sank the potatoes deep into the soil. I don't know if that's quite a thing. Was I lied to? You look like they told me like, was I lied to? No comments on national television. Okay. So they said, but aside that, there are other hazards apart from the security situation which we experience right now, which is one of the major challenges these farmers face. But there are also hazard crops, floods, and what have you. Now, if you collect a loan and you have to pay 27% and you experience that kind of loss, it will be a lot for the farmers to bear. Extremely. So which rates sometimes above 20%, right? Is agricultural credit even sustainable for farmers if we still have the MPR at a little over 27%? Do you think it's very sustainable for farmers? Or if it is not, what other credit structures can be made available for these farmers just so that they don't bear too much? So given the current global environment, not just Nigerian, global environment around what's happening in finance, and I think 27% is, people running our monetary policy are doing a great job, right? They're working at it, but 27% is still very high, right? Without complaining, traditional finance has its own limitations because there's the cost of the money itself, and the rate at which the money has to be given out, and there are a lot of levels that go into setting MPR generally.
thinking about inflation, deflation, all of those other things you think about within economics before you set monetary policy rates. Having said that, I think that 27%, like I said earlier on, is still typically high for agricultural primary production. We're thinking about processing, where you have the opportunity to add more value and then, of course, charge more value, have more spread across it. I mean, it could work, but it's still high. Are we currently making it work? We are making it work. But the way it typically works in the financing is that people collect that money at 27% and go and finance those farmers, right? Because like we talked about earlier on, not every farmer is investable in the sense that we've not yet created those comprehensive collateralization systems, or the systems, just simply put, the systems that present them as investable to allocators of capital within traditional finance. And even when you do that, then the cost of money, like we said earlier on, is a bit too high. When you have those kind of things happen, sometimes I remember I was at the time consulting for one of the big agri-techs now in the country, and we're working on a poultry calculator. And then they were doing crowdfunding, and then you would have to think about how you, when you think about the risk, the mortality rate, it was more poultry. You think about the mortality rate, right? And you have to calculate for that, adjust for that within that spreadsheet, adjust for all the other constituent costs of the production process. And I think, if I remember correctly, then the tenor for the money was 6 months, right? I don't remember what exactly the interest rate, I think it was 15, 18%. But then that process had to happen twice for you to be able to deliver that 15%, and then of course turn a profit, as the agribusiness was actually, championing the whole process. I feel like that's something that is, when it comes to losses and all the other things, the other adverse things that can happen during the production cycle that happens, you have insurance to cover for most
How
of
many
it.
farmers actually insure
So
their
that's the
farmlands?
thing. Goes back to that comprehensive collateralization system. Insurance has to be a key player, a key part of that, right? And it has to be ample cover to make sure that it actually covers for those kinds of outcomes. Again, when you think about it, 27% is still a high ask. It's high risk in some value chains. They're safer value chains, but then when you think about food, you can't just think about one value chain or the other value chain. Every part works. I mean, you think about value chains, that's the term, or the technical term. If you're thinking in real world terms, you're thinking about the different foods that produce the nutrients that make up your food, right? So tomatoes is important. You see tomato value chain. Soybeans is important. Every part of every food that needs to be grown is important, right? So which is why we're thinking more, how do you galvanize capital that doesn't come at that rate and deploy it, of course, having collateralized the system in such a way that that capital is coming back with an interest at every point in time. The things you do on the farm to actually make sure those kinds of things happen to you and just don't happen. There are ways around actually, there are ways around that. The things to do, the systems to deploy, right? Which is not the crux of this conversation, but yes, I would say that those rates are quite high for primary production as it is. So we actually need other solutions, other forms of finance that don't come at that rate.
Okay.
Yeah, thank you.
Now let's talk about solutions, because we've been able to highlight some of the problems that farmers experience, especially when it comes to financing. Now, what solutions do you think? Because I know about anchor borrowers, I know about NISA and NISA funds, and some other agricultural intervention fund. Padama at a point was helping farmers also. But I wouldn't say that these systems have been so productive, although some people actually benefited from it. But the continuity of these kinds of interventions is actually the problem. So what do you think we can do now from here on? Because I hear that the government is also working towards having accurate data, which was one of the conversations we had last month, right? If there's accurate data and farmers are sensitized on what they could do, like you said, on the farmlands that can help prevent or reduce the number of losses they experience on their farmlands. If we have all of that in place, what do you think? What other solutions do you think the government can introduce, farmers can introduce to ensure that they have access to finance and they're able to maintain what they have on the farmlands? Okay,
so one of the key features of the Anchor Borrowers program is that it was single digit. It's a wonderful feature, and that's one of the reasons why it worked. At least the people that got institutional people who got money from Anchor Borrower program were able to get their money single digit, and they were able to deploy that capital, and we saw productivity just go up and up and up, right? So I think we should have more funds. I mean, back to the role of the Food Finance Fund, we should have more funds that are able to galvanize the capital and deploy it at rates that actually work for our food systems, right? I think the kinds of rates that will be, I mean, not sounding very, very practical, the kinds of rates that you want to see for agri-food system financing, ranging from food capturing to food primary production to processing to distribution, delivery, global distribution. You want to have money that comes between 5% and at least maybe 15 to 17% at the highest, right? So typically, putting it simply, you want to have single-digit loans or single-digit financing, whether that's loans or where it's not even financing, where you have grants. Now, there are a couple of people doing really remarkable things in the space. MasterCard, honorable mention, Haifa, who are these other guys now? Agra, great people like kind of financing, you know, that bring the money at zero actually, and then that money goes into great production, right? So Fadama and the other ones you mentioned worked well. What are key solutions? We have to answer directly on solutions. I wanted to highlight things that are working. One of the key things we're trying to do with the Food Finance Fund, like I mentioned earlier, is through decentralized finance, galvanize global liquidity and make it accessible and available to the food system actors who need them. That financing is affordable. We're able to price what rates that money goes out at, and we're able to sustainably do that over and over and over again. Rinse, repeat, make sure that, you know, end to end there's clarity, and this is one of the things that the blockchain does for you. Immutable systems that record all of the processes, right? We're building products around that would help create clarity, supply chain transparency, end to end, from financing to where it went into, what it produced, who it was sold to, what rate it was sold at, and everything like that. So I think decentralized finance is a great solution right now, because it typically allows you to galvanize global capital, like I mentioned earlier on, and make that global capital available to people who need it at rates that actually make sense for our food systems. Yeah.
All right. I was going to ask, do you believe that the Nigerian food finance, access to finance for farmers will actually improve? And I know that you're going to say yes. So let me just go.
We're working on the answer, right? So it's not just a whimsical yes.
Okay, so do you think it's a workable system?
Oh, absolutely. I think yes. I think that that DeFi or decentralized finance is not going to replace traditional finance. I think it's going to be an ecosystem of solutions where you would have, you know, as the role of decentralized finance grows, you would have it play maybe a more predominant role, because it would be a preferred source of capital, given that it will be cheaper than traditional finance. I think it's also good to mention at this point that you have organizations like NISA who are already de-risking this financing. It de-risks the financing, but it doesn't change the interest rate that it comes at, right? I think NADP also does 17%. That's commendable. So the de-risks, the bank gives you the money, but then you pay 17% of the money. That's actually better than the current NPR. So I think yeah. The answer is yes. Yeah.
All right. Thank you so much, Mr. Damion Udoh, for joining us on the conversation today. Now, what today's conversation makes clear is this. Nigerian farmers do not lack resilience. They don't lack skills or ambition. What they lack is structured access to finance that truly understands the agricultural cycle. So until funding aligns with planting season, harvest realities, storage seeds, and market access, farmers will continue to work harder while earning less. And we definitely do not want that, because if they work harder, earn less, prices go up, get into the marketplace, consumers cannot access it, becomes difficult, and then we complain. And it's not a system that we want to thrive in the agricultural space, because the idea is getting more people to the farmlands and making sure that we have enough to eat and enough to trade on. But thank you so much for joining us on the Green Line today. I am your host, will be your host, and continue to be your host. And my name is Martha Alu. I will continue to follow the conversations shaping the future of our food systems. Thank you so much, and I will see you next time.